A very warm welcome to everyone on joining this exclusive webinar session scheduled for Bajaj Finserv employees as well as Bajaj Finserv esteemed customers. Every crisis, we always hear that every crisis comes with an opportunity, and similarly, anytime when some kind of turbulence comes in the market, every dip seems to be an opportunity to balance your investment portfolio. And considering recent volatility in the market, we all have some doubts and confusion what to do and what not to do. We have already seen the Sensex has reached crossed 85,000 in the recent past, and Nifty already crossed 35K, and now it is toppling around the same figures. So, to understand whether this is an opportunity and how we visualize the markets in a going ahead scenario and what the investor should do, we have invited Mr. Mahesh Patil from Aditya Birla Sunlife AMC as the speaker of the day. Mr. Patil, let me just take you into a chance to introduce you in a brief manner. Mr. Patil is the Chief Investment Officer of Aditya Birla Sunlife AMC. As the CIO, Mahesh oversees around 3 lakh crores of asset under management. With over 30 years of rich experience in fund and investment management, Mahesh leads the entire investment team comprising fund managers and analysts. He personally manages the flagship fund Aditya Birla Sun Life Frontline Equity Fund. Mahesh has been with Aditya Birla AMC since October 2005 and was awarded the India CIO of the Year Equity by Asia Asset Management in 2016. He has been awarded Chairman's Individual Award by Aditya Birla Group for being an accomplished leader in 2015. And before Aditya Birla, he has already worked with CMC Limited, Tata Economic Consultancy Services, Parag Parikh Financial Advisory, Motilal, and Reliance Infocom Limited. Without taking much time, I would request Mr. Patil to share his thoughts on the way ahead, considering geopolitical tension, RBI standard rate cuts, and new SEBI guidelines on an FNO. So, what exactly, Mahesh, you think that how the markets look like, what the investor should do? Just please share your thoughts at the broad level, and then we can have one-on-one discussion about the questions which we have got from the customers while registering for this session. Over to you. Thank you, Mahesh.
Yeah, thank you, Mohit, for that introduction. And it's my pleasure to be on this platform with Bajaj Finserv and Bajaj Finance customers. So, as what I'll do is that I'll just give a brief overview in terms of how do we see things, no, at this point in time. As you know, I think the topic was what to do from here, right? We had a fantastic
Yes.
run in the market in the last 3 years. It's been an unprecedented rally, and I mean, it surprised everyone, right? Because it's been
Yeah.
a one-way rally without any kind of a major correction. I mean, I haven't never seen
Mhm.
this kind of a market, even in the earlier bull market when I
Yeah.
was there, okay, in 2003 to 2008 period, 7 period, right? We had, it was also, I mean, it was a much bigger bull market in the scale and
Right.
magnitude, but there were many instances where we saw markets correcting by more than 10%, or even a few instances corrected by around 20% or more. But this
Yeah.
has been a unique in that sense, and to some extent, it's been driven also because of not only strong earnings growth in the last 3 years, good economy, also the large liquidity and inflows what we have seen from retail investors, which has
Mhm.
done that. And now, obviously, after seeing such a big run, and there are some signs of some kind of a market kind of not peaking out but consolidating, and there is some now we've seen that the market is showing signs of some nervousness. We've seen now the
Yeah.
breadth of the market, right, which was very, very strong, right,
Right.
until the election results, which was in May. The market
Mhm.
breadth was very strong. When I say the breadth means the number of companies which were doing better than the benchmark. Okay, that number was
Mhm.
at kind of a 10-year high. That is slowly showing signs of weakness. So clearly the leadership is changing in the market, and we'll talk about that. But just to take a stock of things and see where are we headed from here, and that's what the uh,
Yeah.
the the theme of this today's presentation is. So
Yeah.
before that, let's understand in terms of the macro, because everything comes from the top down macro, right? That
True.
drives the company, and then that in turn drives the market returns from here. So if you look at
Mhm.
on the Indian economy, because that's where the macro starts off with. So Indian economy has done very well since COVID, and we've seen that it is been one of the fastest growing economy amongst the large economies in the emerging markets, right?
Yeah.
And if you look at this recovery from pre-COVID and now, it has been driven primarily by the investments this time around. So
True.
investments as a percentage of GDP, that number was kind of trending down from 2012 to 2020. And post-COVID, we have seen because of the big fiscal stimulus which was given by the government, right? A lot of government investments went in that period. We saw investments have actually recovered well. In fact,
Yeah.
investments is now tracking higher than the pre-COVID trend line. It's
True.
the consumption which is still slightly lower, and that we are expecting it to improve now as slowly. I think the rural economy, which was
Mhm.
slow to recover post COVID, is showing now some green shoots. We'll talk about that. But clearly, I think the big picture is that Indian economy is in good shape. It because of the big reforms what we have done in the last 10 years, and the macro stability, as we'll talk, the sustainability of this growth looks very good. It's not predicated
Yeah.
on a few sectors, right? There are multiple sectors which are doing well. The investments picking up. The real estate sector is again recovering. Okay, after a long period, we have seen the auto sector pick up, and so I think all that is driving it. And if you look at in this chart over here, I don't know whether it's visible or not. Okay, we can see this slide. So if you look at even going forward, India would be the
Mahesh, sorry,
yes.
but we can't see the slide. Can you please share that?
Just a minute. Yeah, can you see it?
Uh,
No?
yeah, it's downloading. Yeah.
Yeah, just a minute. I just stop it again.
It was uploading earlier. Now it's back to the same screen. Can you
Yeah,
retry?
it should come again. Yeah.
Yeah, just a second.
Yeah. Can you see it now?
Yeah, it's downloading.
Okay. So, yeah, I think now it's there, right?
Mm, not yet,
Okay.
but yeah,
No
it's
worries. I think
yeah, I
I'll
can
take
see
it
that.
with me.
Yeah, yeah, it's
Yeah.
visible. Please, Mahesh, go ahead.
So if you look at this chart, okay, which talks about the GDP growth in the past, and more importantly, going forward, right, in the next 4 years or 5 years, so India
Mhm,
will has a potential to grow at around say 6.5, 7%. I think in that
mhm,
range, which I think is a healthy growth in the context that global growth is not that great. You know what's happening in
yeah,
US, right, in China also, which is to be the fastest growing economy. If you look at in
mm,
the past, growing 10% or thereabouts, or
mm, mm,
is likely to grow at just about under 4% or so. So
yeah.
clearly, India is the best place to be in at this point in time. And also, if you look at India's overall dependence on global growth is also fairly low in that sense, right? Uh, so that is another important factor, okay, which we need to see because in an environment where the global growth is slowing down, India's sensitivity to global growth is very low. That means a lot of the factors which are driving India's growth are more India centric, right?
Mm,
We are
mm,
not so much dependent compared to a lot of other emerging market economies. If you look at in this chart over here, their
yeah,
sensitivity to global growth is much larger. So if global growth slows down, like US slows down or China slows down, they will impact. So we were to some extent insulated from that sense, so which is again a big facet to be considered. And the biggest thing for India, I think, what has changed in the last, say, 5 years or last 10 years, I would say, right, is that the
mhm,
macro stability which India has reached,
yeah,
right, on various fronts, right? So when I say macro stability means how inflation is, right? So we have seen
yes.
that inflation is now pretty much under control. I think we are tracking somewhere around now 4.5% or so, which
Mm,
earlier used to be around 9% or so, right? It used to be high single
right.
digits or so. So
Mm,
clearly, RBI has been able to tackle that and bring inflation under control, and which is the most important thing. Secondly, is CAD, right? For any emerging market, it is always the current account deficit and the fiscal deficit. These were the two
mm,
problems which were there, right? For any emerging any economy. Now, current account deficit is very much under control because what has happened is that over a period of time in the last few years, especially post COVID, we have seen
mm,
India's services exports, right, which is IT services. and other
Yeah.
services. A lot of global companies are outsourcing from India. It's not the IT services alone, but a lot of back offices are there. You would have seen in major cities like Bangalore, Delhi, Pune. A lot of these global MNC companies have got a back offices. So
Yeah.
services exports are now balancing our imports, like oil imports, and that's why our current account deficit is now under 1% also, right? So which is again very important, I think, to look at. Also, what is means is that as a result of this, our forex reserves are very, very strong. And as a
Right.
result, when you say there is a macro stability, means the volatility of the currency, okay, is what gets reflected into. So if you look at the rupee volatility, okay, in the last 2 years has been one of the lowest compared to all other currencies.
Hmm.
Even the our interest rates, right, our 10-year bond yield also volatility has been on the lower side. So I think that is the biggest change which has happened in terms of macro stability, which is there, which
Hmm.
invariably, which would mean that India's premium, right, risk premium for India, which is there normally, which you call, okay, that goes down. So what it means is that if that happens, that means uh, the investors are willing to pay a slight premium for India because of
Yeah.
that stability, assuming other
Hmm.
things are being equal. And also with the fiscal consolidation, which the government has really gone through and to manage our fiscal side, I think, and with
Hmm.
our growth, I think we could probably see a ratings upgrade down the line. I mean, that's a next year. I think that could again be a big event for India, which will lower your cost of capital for many companies. So I think, so that is the, I think, the big change. Okay, what we
Hmm.
see
Hmm.
from a macro standpoint. And also from a liquidity standpoint, I think India, we've seen that until a few months back, okay, the system-wide liquidity was very, very tight, right? The banking system
Right.
liquidity was tight. Now RBI is okay to ease off because inflation is under control. So we think that the overall banking system liquidity is now under positive territory, and that should help even the challenge which the banking sector currently is facing because of
Hmm.
tight liquidity in
Yeah.
terms of deposit growth also, which has been a big challenge, which is to some
Yes.
extent hampering the credit growth. I think that will
Yeah.
also get addressed. And looking at now the situation where we've seen inflation under control, US Fed has cut rates.
Hmm.
So
Hmm.
the RBI also will do its bit in terms of cutting interest rates. We don't
Hmm.
expect an immediate rate cut, but possibly at the end of this fiscal year, because India growth is still very strong, right? So there's no need to do
True.
immediate rate cuts. But clearly, the
Yes.
system liquidity will improve, and that's the reason why rates will come down. You've seen already 10-year bond yields have
Hmm.
come down from 7.4% to around 6.8% or so. We think
Yeah.
another 50 basis point rates could go down over the next 1.5 years.
Hmm. Hmm.
On the demand side, if you look at, as I said, the demand was still slightly, recovery has been slightly slow on the consumption side. The good news is that a rural economy, which was weak, is slowly starting to now come back. If you look at over here, I mean, urban economy picked up much earlier post COVID, right? Rural economy is now picking up, and that is primarily driven by wage inflation in
Hmm.
rural India is now slightly better because inflation has come down. We've
Yeah.
seen that the job demand, okay, from the Manrega has come down. That means there is the employment is improving. Also, we expect good monsoon, right? Monsoons have been
Hmm.
fairly good. The spread has been good. It's in line with normal, and that should mean that the kharif crop should be good. And the second half, I think you could see consumption, which was lagging, also starting to improve a bit. So that's the broad takeaway which we have. And finally, for the market perspective, this macro, how it drills down into corporate earnings growth is very important because that drives the market, right? How the earnings grow. For a market perspective, it is the EPS growth, okay, which matters. So if you look at in this chart over here, since post COVID, we have seen that the corporate profitability has seen a significant improvement. This chart
Hmm.
shows corporate profit to GDP ratio. I mean, that ratio had peaked out in 2007-8, right, in that earlier bull run. And it was steadily
Yeah.
coming down because of various factors, right? Pre COVID, we had demonetization, we had the banking and financial services crisis. But post COVID, a lot of companies have been able to really improve their working capital. They have been improved their costs. So EBITDA margins have gone up. So overall, the profitability of corporate India has seen a significant improvement in the last 3 4 years, right? So one is this corporate profit to GDP ratio, but also
Hmm.
on the return on equity, as you call it, right? ROE, that has
Hmm.
also improved. So what that means is that when your proper profitability and health improves, the balance sheets are in good shape. Um, obviously the multiples, right, it will also be higher, right?
Hmm.
So
Hmm.
this is again a big change from what it was, say, around 4 5 years back. Also, the profits which have been generated in the last 3 4 years, companies have used that to lower their debt. So there's a
Right.
significant debt reduction which has happened in corporate India's balance sheet, and the debt equity ratio is now at a 10-year low. It's now actually below 0.5% or so,
Yeah.
right? So I think that is 0.5. So that is again a big change, okay, which you look at from a
Hmm.
macro standpoint, and all these factors, okay, leads us to believe that India. People say that India is expensive, and we'll come to that, right? But these are
Yeah.
fundamental changes which have happened, and as a result of that, I think the valuations are on the higher side, which we have been talking about, and the markets have been, people have been raising concerns. But we want to realize that a lot of things have changed what it used to be around, say, 5 years back, right? Our growth is
Yeah.
much better. There's better macro stability, which is there. The return on capital and the ROE profile of companies has improved significantly,
Hmm.
and that's I think the reason why the markets will probably remain slightly on the elevated basis. So when you say market is expensive again, there's been a lot of talk that there's a big rally, the markets have run up, good returns, but is the market really expensive? So if you look at, there are two parts to the market, right? One is the large caps or the Nifty, as we call it, right? The second
Yeah.
one is the broader market, which is the mid cap and the small cap.
Yeah.
So if you look at the Nifty, right, and this chart shows the Nifty price earnings multiple on a
Hmm.
P basis, it is actually similar to what it was in the pre-COVID
Hmm.
peak, right? If you look at in um, 19 early, it was somewhere around close to around 21 or so. It is
Yeah.
similar, I think, in that range. It's not that expensive, and we've seen that in the last 5 years, a lot of things have turned positive, right, than what they were earlier. So what has happened is that in this period, the company's earnings growth or Nifty earnings growth has been
Hmm.
in more than 20%, right?
Yeah.
And Nifty return also has been more or less in line with the earnings growth. So it has
Hmm.
tracked more or less in that. So it has been primarily driven by the earnings growth. On the other hand, if you look at the mid cap and small cap, right? So there, if you look at the returns in the last 3 4 years, okay,
Right.
uh, partly it is driven by earnings growth, and
Hmm.
partly, I mean, 50% also approximately is driven by re-rating, right? That is, the multiples have got re-rated. I mean, the stocks have
Yeah.
become more expensive. And this chart shows here how the mid cap, if you take mid cap as one segment, how the price earnings multiple are compared to
Hmm.
the historical average. Well, the
True.
Nifty is still around the long term average. Okay, the mid cap P multiples are significantly higher, that around 33 times, right?
True.
So this is one, and even the relative valuation of mid cap vis-a-vis the Nifty is also at a kind of a all-time high. So that makes us believe that the market is expensive, but only in certain pockets, right? Okay, the mid cap and small cap index, and that is also the reason because a lot of money has moved into that space in the last 2 years because of uh,
Hmm.
the inflows, okay, into the mutual funds in the mid and small cap category has been very large. A lot of retail money has gone into the market, direct money, which is primarily into the mid and small cap space, and that's where one needs to be slightly careful, and that's why I think this is an area where you need to slightly be careful, reduce the risk over here, and
Hmm.
then probably large cap is where I think you need to be more present if you just look at from an asset allocation perspective, because I think this is a time where you need to now start to protect your gains, right? Whatever
Yeah.
returns, what you've seen in the last 3 4 years, I think the market will do well. It will make new highs, but there's going to be more volatility in the market. And we've seen now, we'll talk about that. There are certain risks which are there, and we've seen that the breadth is now starting to weaken a bit, right? As
Yep.
I said, no. So we've seen that in the last 2 3 months, investor would have seen that there are quite a few companies which have now probably down say around 20 30%, okay, from their recent highs, right, in the period. So I think that is one need for caution, where you need to be much more discreet or much more stock specific, okay, when we are investing into and looking at valuations. I think the big risk taking which was there, right, in the last 2 3 years, risk taking was getting rewarded disproportionately. I mean, any stock
Hmm.
which you put into the market, I think that went up. Now I think the market will be slightly more discerning, and that's why you have to be really careful in which companies you are investing into, looking
True.
at companies where the fundamentals are good, where the earnings growth is there is visibility of earnings growth, and obviously also valuations. Another just chart to show over here is that the momentum of earnings growth is now slowing down. One is that, right? So last 2 3 years, we have seen very strong earnings growth, around 20% plus. I think now, I think this year, if you look at, we're expecting around 10% Nifty earnings growth. And the
Okay.
reason for that is that the big gains what we saw in margin improvement, and that are now
Mm,
normalizing, right? So your
mm,
earnings growth will be now in line with your top line growth, which is roughly
true.
around 10 to 12% in that range. And that
Okay.
is, if that is the case, then your return expectations should also kind of moderate down,
Yeah.
right? In line with the earnings growth. That's one point which I think investors should bear in mind. Also, in this chart, what I'm trying to show here is that earnings revision, right? Estimates, right? Analysts, they make earnings estimates, uh, which are which are earnings going forward, how the earnings are going to
Mm,
change. So if you look
mhm.
at in the Nifty, there's not much change. That means there's no
Yeah.
downgrades to earn. But in other market, the broader market, which is the mid cap and small cap, okay, we are seeing some downgrades to earnings. So that's an area where we need to be slightly more careful going forward. We've seen the valuations there are slightly on the higher side, and also there's some disappointment in earnings, okay, which is likely to happen, and that's what it is indicating in the mid cap and small cap space.
Got it.
And finally, I would say that India is, because of the outperformance, India has now become a very significant market on a global front, right?
Yes.
So our market cap, India's share of market cap as the global market cap is at an all-time high, around 4.6%. So India is
Mm,
now, in terms of market cap, is the fourth largest market, right? Just behind Japan and China. Interestingly, if you
mm,
look at China, right, where the China's GDP, right, is significantly higher than India. Right, India is around a $4 trillion GDP. China will be somewhere around $18 trillion. So it's almost like four times that. But in
yeah.
the market cap, actually, we are not too behind China,
Mm,
right? And that's reason why, because China has
mm,
not really created as much wealth. While the GDP has grown, but the markets are not created well because the profitability of those companies have not been that
unfortunately.
great. The EPS growth was not that strong because companies have diluted without really bothering about the cost of whether they're generating
Mm,
enough return on capital compared to the cost of capital. So I think India
got it.
can probably become one of the I mean, after US, it can become the second largest market cap. And when that
Got it.
happens, global investors can't ignore India, right? They will
Yes.
have to come at India. So, like, FIs
Mm,
have been slightly negative on the market, and because the valuations, it's been the domestic investors which have been driving the market. But I think they also would want to have a pie of this India growth story, and that will, I think, you would see foreign investors coming into India because there's macro stability, and they see a long-term structural growth over here. So that's the
mm,
big picture, I would say. Just before
great.
I cut short, just two, three things in terms of
Mhm.
factors, styles, what we are seeing in the market, right? So we've seen
Yeah.
that there are various factor or styles which play in the market, right? One is traditionally is quality and value, or quality and value and growth, as we call it, right? So here you can see that at different periods in the market, sometimes quality does well. So here, quality is the blue line. When these are
Okay.
mean quality stocks. When I say quality stocks, mean companies which are generating higher return on capital, where the volatility earning
Mm,
is lower, and value are value stocks, as we know, right? Company which are low price to earning, price to book. So since if you look at in the last 2 years, value has done very well, right? So that's where all the PSU stocks did very well. A lot
mm,
of utilities have seen a big run.
yeah.
I think now, as again, as interest rates, okay, when interest rates go up, okay, we see that quality starts to get impacted a bit, right? Now with
Yes.
rate cuts coming in, okay, we see
Mm,
quality will start to now again come back, and we've seen that in the last 2 3. If you look at the indices, like Nifty has got quality and value indices
mm,
that has started to outperform, and that is because
got it.
now you would want to go into safety a bit. You want to, your return expectations are moderate down. You don't want to chase high returns, but you want to be in companies and stock where at least there's reasonable certainty that the earnings growth, okay, will come to what you're expecting. So this is the time, I think, to move towards better quality in your portfolio, uh,
Mm,
reduce the risk in the portfolio, and stick to companies and this thing which where the earnings are reasonably stable, or where the earnings growth visibility is much better. So I
So,
think
Mahesh, related to this, I have a
yes,
question. When we say that investors should take into consideration while deciding the portfolio from the fund point of view, which mutual fund category, SEBI category, you suggest in that case, which will take care of the scenario for the customer point of view, that not to invest in super expensive or high valuation stocks, or
yeah.
maybe look for quality instead of just value going forward.
Yeah, so I think in this context, I think as I said, I mean, one should not be too negative on the market. As I said, at the same
Yeah.
time, there are pockets in the market which have, because of the exuberance, and therefore we have to be careful. So if you look at from a mutual fund perspective, I would say that, as I said, large caps, right, which we have seen how Nifty is
Yeah.
not as expensive as what it looks like, right? Okay,
Right.
compared to the historical and things. So I think a larger allocation can go to a large cap fund, okay, or a flexi cap fund, because flexi cap funds I mean, they're typically mid large cap will be around say 65%, 60, 70%, and balances into mid and small cap. You want to also be in mid and small cap, but more selectively, right?
Okay.
Because there always be bottom up opportunities in the markets, and you've seen
Yeah.
there are new companies which are there, so you don't want to miss on that. So a large cap and flexi cap, I think, will be the two categories where your dominant allocation can be at this point
Mhm.
in time. In the last 2 years, a lot of money has gone into mid cap and small cap, so that
Yeah.
proportion for investors' portfolio would have gone up. I think that needs to be kind of a rebalance. Also, since the risk reward across asset classes, right, whether it is equity, whether it is fixed income, people have
Yeah.
forgotten fixed income for some time because they were chasing returns. But fixed income
Hmm.
also provides stability to the portfolio. And now
True.
interest rates are at the high level, and you would see rate cuts down the line. So you might see some
Yeah.
kind of a gain in terms of if you're taking longer duration, right?
Hmm.
And also gold and other silver as a asset class, right? They also have done reasonably well. So I
True.
think a multi-asset fund or an asset allocation fund,
Hmm.
right? A
Hmm.
hybrid fund I think also will be a good alternative where you can play across these various asset classes,
Right.
which are also offering a reasonably good risk return, right?
Yes.
and
Yes.
and and with the diversification, your
Yeah.
volatility, okay, goes down. So on a risk adjusted basis, the returns, okay, in a multi asset fund or a asset allocation fund are good, and they're also with a slightly higher equity allocation, right? Typically
Right.
around say 65% or so. So they also give returns which are slightly lower than equities, but with
True.
significantly lower volatility. I think those are the funds which I think one should be looking at, purely from a more diversified thing. If
Yeah.
you're playing
Yeah.
thematics also, right? Lot of themes. If you look at in the last few years, we've seen a lot of thematic funds come to the market in the mutual fund. A lot of money has
Yes.
actually been garnered over there. So
True.
there you have to be
True.
slightly more careful, because some of the
Yeah.
themes, people normally look at themes which have done well in the past and come in, and there it can be slightly cyclical, right, in
Yeah.
nature, and there the volatility could be slightly higher. But if you ask me the themes which we like at this point in time would be, one is the banking and financials, okay,
Hmm.
because this is a banking and financial, if you look at the index, it has underperformed, right, in the last two
Right.
years and we think that the valuations there are more reasonable. Large banks, if you look at it, their valuations are not that expensive,
Hmm.
and overall credit growth, while it is slightly weaker, but I think we should be in line with your nominal GDP growth or so, right? So
Right.
that's one sector which we like. Apart from that, the consumer space, right? The consumer
Okay.
discretionary. I think that's the sector which is again a high quality. These are all better quality names, right? In terms of
Right.
return on capital, cash flow, and as I said, consumption is now coming back a bit, right?
Yeah.
Rural consumption will pick up, and structurally, the discretionary consumption in India will go up because the young generation is more aspirational. They are spending on
True.
more premium goods. Your per
Yeah.
capita income of India, which is at an inflection point of around $2,600, where as it goes above that, the demand for discretionary consumption will go up. So that's another theme which we think looks good if you really
Hmm.
want to play the thematic side, or theme based investing if you want to follow.
Great, great. Thank you so much, Mahesh, for answering this question. I think this is very fruitful for mutual fund investors per se. They want to know exactly that where they should invest, and it is not for everyone's. Everyone is not capable of investing in either large cap, small cap, mid cap, and deciding when to switch, when to rebalance. So I believe you are right that flexi cap or multi asset fund kind of scenario makes more sense for these kind of customers, in the market scenario per se.
Even in a large cap fund also, I would say, because
Yeah.
people have moved away from large caps. Okay, people have wanted to
True.
chase return, but if you look at long term returns of you're buying into good quality blue chip companies, right, which will be more
True.
stable in this kind of an environment when there are some risks, okay, which are there in the market and the horizon, right? That's what. It's not always the absolute return; it's also the risk
Yeah.
adjusted return which investors
Absolutely.
should keep in mind.
I think diversification is something which is very critical at this point of time, which investors should look at. And great. One more question we have, a very interesting topic these days, geopolitical scenario impact to Indian markets. Will you be able to, Hamish, give some view that how the geopolitical tensions can have an impact on the customer and what the mutual fund investors should strategically do about their own portfolio in these scenarios?
So I think the geopolitical risks have kind of gone up in the last couple of years. We saw Ukraine crisis, which is
Yeah.
still not fully resolved. It is still there. Okay,
Mm.
though I think the impact of that, as the market has totally ignored that, but it can escalate. What's happening in the Middle East between Israel and Lebanon now? Okay, earlier it was against the Hamas, and also with Iran coming into the place, it's becoming slightly more complex in that region, and that region is also where you have oil, right? So it can have implication on oil. While India is now to a large extent a dependence on oil volatility or the impact is come down to a large extent, say compared to
True.
5 years back. Because as I
Yeah.
said, our exports, our services exports are now easily significantly higher than our oil import bill, which is there, right?
Right.
But having said that, if there is a flare up, it will lead to some amount of impact, right, in terms of our current account and on the rupee per se. So I think
Mm.
these are some of the risks which are currently there. I think when the escalation happens, how it happens is very difficult to predict that. Also,
True.
these geopolitical risks also lead to supply side disruptions, right,
Yeah.
which are there, right, which leads to then inflation, right, because inflation
Mm.
also we saw right earlier during COVID time was because of supply side shocks, and the
Yeah.
whole premise of where the central banks are now cutting interest rate because inflation is now coming under control. But
Mm.
if geopolitical risk grows up, then the supply side, the the supply chain issues, disruptions can lead to some higher inflation, and
Mm.
that's what I think we need to keep in mind and factoring. So I think I would say that that's why the reason. I mean, frankly, some of these geopolitical risks which are there, India probably is slightly not drawn into any of these things, right? Even during
True.
Russia-Ukraine crisis, we saw that India didn't really get impacted. In fact, it benefited in a way, right? Because you could get oil from Russia at a much cheaper this
Yeah.
thing, right?
Yeah.
And India is perceived to be a slightly neutral, right? So while China at one end, because of again the challenges which are there on the China and Taiwan relationships, so the Western world wants to dealing from China. India is benefiting because they want
Yeah.
to dealing from China from the supply side. India is benefiting. Companies are benefiting in a sense from that. So I don't see such a large, but it increases the risk perception, and especially when the
Mm.
markets have rallied so much, there is some amount of profit booking and volatility, I think, which can
Yeah.
come in. Also, that's why that diversification is very important, right? So in a
True.
multi-asset fund, as I said, you also have gold, right? Silver for that matter. So
Yeah.
gold is a good hedge against any kind of geopolitical risk or whatever people
Absolutely.
want to fly. It's a flight to safety, right?
Yeah.
And gold has also the demand for gold is also coming from other reasons, right? Where the central
Yes.
banks are looking at it.
Yeah.
So while it might not give you great returns, but it's because of the inverse correlation,
The
it can
safety.
provide stability to the portfolio, and that's why best way to put in a multi-asset fund at this point in time, right? With
Yeah.
these risk perceptions, okay, which are there.
Absolutely, absolutely. Great, great, great. So, Mahesh, in that particular scenario, we understand there's so much of positive around. What exactly well-versed investors should do, whether to put money in lump sum or should take the STP route at this point of time?
Yeah, so I think what we've seen is that investors have been coming to large extent to SIP, right, which is a regular monthly. When that's the best way to enter into the market during the highs and the lows. At these levels, markets are
True.
slightly elevated, right? So you do want to be aggressive, right? But
Hmm.
at the same time, you also don't want to time the market, right? Because people have
True.
been trying to time the market, and the markets have continued to move up, right? We don't
Yeah.
never know when the correction will come in. So
Yeah.
systematically investing into the market, I think, is the right way to do it. Any lump sum money which is there, I think an STP can be a good option for that, because there are a
Hmm.
couple of events, right? Which are, we have the US elections, which are there now
Yeah.
around the corner. We have state elections also, right?
Yeah.
In Maharashtra, okay, which is an important one to look at, right, from the
True.
current government stability, right? Because
Yeah.
the general election outcome was not fully, it was not a
True.
very clear mandate, right? So
Yeah.
market will look at how the election outcome happens in Maharashtra, which is a
Hmm.
large state. A good thing is
Hmm.
in Haryana today, the elections were slightly positive, okay, where the
True.
ruling party is
Yeah.
able to keep its position over there.
Yeah.
And then the geopolitical risk, okay, which we talk about. China also is another one thing which has cropped up recently, is about China government trying to stimulate the economy over there, right?
Hmm.
So while it is a tough job, China's economy, but they will do
Yeah.
some measures there to stimulate.
True.
Currently, they have given a monetary stimulus.
Hmm.
They expected to give a fiscal stimulus. So some money
Hmm.
could move to China, global money, not talking about domestic money. So that could
Right.
lead to some volatility in the foreign flows, which
Okay.
are there. So I think clearly, I think it's no longer a kind of a one-way rally what we've seen
Yeah.
in the markets
Yeah.
in the last 3 years. Clearly, that's what it's looking out. However,
Hmm.
the trend is up. I mean, there is no mistaking that we are still not. I mean, a
Got
10% correction is possible, quite possible. We haven't seen that, but and that's a good point to buy. It's a market to buy into the dips, not to be
yes.
really
Yes.
worried.
Yes.
Okay, in those corrections. So I think an STP or an SIP, I think, would be the best way to enter or participate in this market.
Great. Great. In fact, one interesting thing happened today after lunch when I was taking the stairs to come up. I met the guard boy of our office. He was stepping
Hmm.
down from the lift, and he was just asking me, "Okay, sir, please suggest me a fund where I can start a SIP." So
Hmm.
I was amazed to see the interest of a person from that category also, that they want to invest in. Maybe the journey of the kind of journeys today we have simplified so much, and the kind of education we are working towards, that people are quite excited to start their own SIPs, even if they want to start with $500 per month. So you are right that SIP seems to be a best way to invest in mutual fund, and we have seen people creating wealth, having a disciplined investment and regular investments per se on a monthly basis by doing SIPs. And that is why we feel that yes, once the discipline is there, and mutual fund can be a wonderful tool to create wealth in the
Yeah.
scenario.
No, I
So
think
with
you
this,
said very
yeah,
rightly. Interestingly, just one data point. See, what happens is that people who have invested in the market and stayed, right?
yeah,
If you look at their data, no, they have seen a good return on their overall portfolio, right?
true,
And done the
true,
SIP.
yeah,
Who have come into the market at various points in time and then got out and again come in, no, their returns have been much suboptimal. And that's why many times
absolutely,
when people say that we show always these charts, that equity long-term returns or fund
yeah,
returns last
yeah,
20 years, 30 years is
mm,
XYZ, right? Whatever returns
yeah,
is that. But investors say, "Mera return is not आया because they have
true.
not followed discipline and
No one's
and
been
lost,
investing for 20 years. Yeah,
yeah. So I think staying invested, obviously you need to have. That's why you need to have different categories of fund risk profile,
yeah,
right? Depending on your time horizon, the liquidity, what you
true,
require.
true,
But I think for wealth creation, and that's what is rightly said. People have realized that if you want to really do protect against inflation and also be
yeah,
able to do something corpus for your goals or even for a
yeah,
retirement for that matter, right? Long term, or to ensure your
absolutely,
financial security, it's
yeah,
important to invest into an asset class which can give you better returns over the long run.
mm,
Obviously, it is risky, so that's why you need to manage that in a disciplined manner, right? That's,
mm,
I think, a realization, I think, which is now coming in, and that's why the inflow which is coming into the market, or rather through SIP, I don't see that abating, right? Despite some volatility coming in
true,
in
true,
your
true. And in fact, the recent past, the kind of SIP inflows we have seen in the last quarter, that clearly shows the kind of interest people are having and the right decisions being taken by the investors per se. Great. Thank you so much, Mahesh. We are done with the questions we have received from the participants, and I must say this is one of the interesting session we had, where you gave us the view of the macro, micro, how the valuations look like, what is the way ahead from this current scenario, and what kind of strategy investors should have. The last question about Aditya Birla AMC. What is unique about your AMC in terms of investment philosophy? If you can just take a couple of minutes to share that before I close.
Yeah, sure. So I think again we are a large, I mean, old one of the oldest asset management company, right? We are completing 30 years now. This was a time
Yeah.
when 30 years back the private sector mutual fund industry, right, came
Yeah.
into being. Right, earlier it was the erstwhile UTI which was there. So we have
Hmm.
seen many cycles and ups and downs in the market, and that has also made us much more stronger and has also kind of shaped our philosophy, right, our processes. So clearly, I think we want we are focusing a lot of domestic internal research, right, because that's the foundation. So we want to be known as a strong research-backed fund house, and
Mhm.
doing our own original research. So strengthening our investment research team, and now the market breadth has improved. A lot of many companies which have come into the market, right? So you need to do your original ground research. So focusing on bottom up research is our main strength. Also, as a philosophy, we want to invest into companies, right, which are growing faster. Inherently, we think that if we invest into companies which are growing faster than the industry or the nominal GDP growth, that's where your long term wealth will be created. Also, the company should be generating reasonable return on capital employed, right?
Yeah.
Because that's what creates long-term wealth. We saw that example of China, right? China
Hmm.
economy has grown, but market has not given return because the return on capital of most of the Chinese companies is suboptimal. So that means
Yeah.
you're continuously diluting, and your EPS profit growth is there, but there is no EPS growth. So we
Yeah.
want to look at companies, okay, which are generating at least reasonable return on capital employed,
Hmm.
and where the cash flow generation is good, and finally these there should be a more sustainable growth, right? I mean, we are looking at a company which can continue to grow because of either some competitive advantage at a longer period of time. And finally, management, I think, because that is, I think, a key differentiator or a qualitative factor, okay, which
Hmm.
defines a company which uh, can be able to managements which are, when I say good management, means company which make the right capital allocation decisions. Okay, they are able to pivot at the right time their business if there are any challenges, okay, which are there. And yeah, so I think betting on the right management, and that's the substance in terms of what we look at
Yeah.
when we invest into a company. I mean, that's the core of our portfolio, okay, which we want to, which can which will generate alpha. Obviously, we take some tactical positions to play the various themes, but the core of our portfolio is premised on this philosophy, which we think can give long term good returns. So I think we think India is a growth market. Okay, it's a growing economy. You have to bet into good growth companies, but to buy them at a reasonable price, okay,
Yeah.
and bet on the right management. That's the this is the philosophy, okay, which we do the investments in the portfolio, which we think in the longer run can give good returns and be able to generate alpha, reasonable alpha vis-a-vis the benchmark.
Hmm.
And finally, also a lot of focus on risk management, because what
Yeah.
we have learned in the earlier crisis is that focus on risk management important to ensure that one doesn't go overboard, right, in a bullish market, either at the stock level or a sector level. So you have proper risk management in place, which ensures that even if there are market shocks, okay, you don't get impacted so much, and you're able to then bounce back much faster.
Mhm.
So good, strong focus on risk management besides a fundamental research driven approach is what clearly encapsulates our philosophy of investing.
Wonderful, wonderful, Mr. Patel. I believe this is very convincing to know from the existing customer and the new customer to the AMC also that what kind of metrics are in place for the Aditya Birla AMC to consider the value for the money of the customers. And we believe that yes, the kind of growth the AMC has shown in the past, it will substantially grow in future as well. And wish you all the best. And thank you so much for your time. And thank you everyone who has joined this session, live session. We will keep bringing some kind of esteemed speakers from the industry who can help you taking some wise decision about your own portfolio and to understand how the markets are doing and how the future look like, so that you can make some wise decision about your own investments. And thank you so much, Mr. Patil, once again, and we'll definitely love to welcome you once again in couple of months to have a fresh outlook on the markets and a fresh view on the investment portfolio of the customers. Thank you so much.
Thank you. My pleasure.